All right, so we spoke about permanent life insurance and how you have that option to grow cash accumulation in it. And then we spoke about how it could perform in an index way. So now let's talk about how you can access that money after you accumulated it. So the old school way that insurance companies used to let you access that money is called what we call annuitizing money. And when you annuitize money, that's when you give up all your rights to that lump sum for that promise of an income stream. And when that happens, a lot of people were turned off by that because they don't want to give up the rights to all that money for a income stream that, could pay you for however many years you have left on this earth. So it's something that started to be frowned upon. So the new school way started to cater to the marketplace. And the new school way allows you to access your money, but also keep the rights to that lump sum and your death benefit. So you don't have to sacrifice those two things. So it's giving you the accessibility of your money, keeping the flexibility on, how you want to access that lump sum later or that death benefit later. You get to keep the guarantees that come with life insurance as well. And it also keeps the control in your hands and not the company's hands. So it's a beautiful place to be. So the new school way that you can access money is through a few different ways. One is through withdrawals. Withdrawals is where you withdraw your money from the policy, but that money is going to come from the death benefit specifically. So the more withdrawals you take is when you'll see that death benefits start to slowly decrease. And when you participate in withdrawals, you have to be very careful because you can run into a place where you lead your policy to become a lapsed policy where you don't even have a policy anymore. So you want to be very careful with the agent that you're working with because they have to know what they're doing, because you can put yourself into a bigger hole where you can create phantom income. When you create phantom income, that's when you'll accidentally receive a very big bill from the IRS, because then you're being taxed on income. So withdrawals can be a very eerie place to be unless you know what you're doing. And again, be wise on who you work with as an agent in that category. So that's withdrawals. The other way you can access your money is through loans. When you're working with loans from your policy, 99% of loans are going to be variable loans. And what that allows you to do is, because it's quote unquote a loan from the insurance company, that's what allows your money to maintain the tax-free benefit to it. And when you take a loan, basically the size of the loan that you can take is always determined on how much of that cash accumulation you have in your policy. And that's what the insurance company is going to use as collateral for that loan. Think of it as your money, but they have to give it to you in the sense of a loan for tax advantages, and because that's what insurance companies do on that end, because they're going to give you like a interest rate with it. So for example, let's say your loan is 4%, but your money has been growing in that policy on average 6%. So you don't have to pay that loan back unless you want to, but because your money is growing faster than that interest rate, we call it a washout loan, where that loan will basically pay itself back over the years. Okay? So that's the second way you can access your money. So one is withdrawals. The second one is loans. The third one is what we call a lifetime income rider. And the lifetime income rider allows you to have the promise of a lifetime income stream, but you also get to keep that cash accumulation and that death benefit. But the longer that you keep that lifetime income stream coming through, you're going to slowly see that cash value slowly decrease, as well as that death benefit slowly decrease. So you have three ways to actually utilize it or access it: withdrawals, loans, or the lifetime income stream. So that's where people basically create a life insurance based retirement plan in that sense. So when we speak about accessing the money, we'll also speak about how to actually create this accessibility to what we call generational wealth opportunities. And that'll be one of the next videos we speak about. All right.